Gaura Sengupta, Chief Economist with IDFC First Bank, joins us now. Let's connect and understand from her what she makes of the low IIP data. Now, economy is doing okay. That's what GDP told us. If economy is doing okay, IIP should actually be leading it from the front. But there was a drop in IIP data. Why was that?
So even the GDP data that we saw in Q4, though it was much better than expected, showed the similar story that IIP is telling, that manufacturing sector is a bit weak. So what IIP is not capturing is the services side, which has been, I would say, relatively stronger than manufacturing. Services is more a story of domestic demand still holding up, also support from government in form of capital expenditure, etc. Uh, as well as real estate activity, which is held up. In IIP, the weakness that is telling you is one, you have to understand the IIP index is a bit volatile. It has a very old base. It's yet to get revised. So there's a bit of volatility there. Secondly, manufacturing sector production is very closely linked to how our merchandise exports perform. That has remained weak since last year. So that is what the trend of IIP is telling you. It's also telling you the urban side of consumption is a bit weaker with decline in both durable goods production as well as non-durable consumer goods production.
So given that we had early monsoon this year, they the jury is not out what would be the tariff impact. Manufacturing both locally and globally is in a disarray. Should we expect a similar kind of a numbness in future IP reading also?
Yes, I think IIP is going to stay as long as your external sector growth is not going to be better. You will see the manufacturing segment within IIP remaining a bit weak. We will see some support through IIP in terms of construction activity. If you actually see capital goods production, infrastructure production, that has remained relatively stronger. That is reflecting the fact that the center as well as state government capital expenditure in Q1 has picked up. So you will see this similar trend of sort of a muted growth in IIP continuing, which will be a factor of uh, weaker export growth because of the tariff uncertainty. Even if, let's say, India reaches an agreement with the US, which looks likely, the uncertainty has eaten up half of 2025. And that itself has a negative impact on global growth, global demand, and also on how our merchandise exports are performing. So yes, we do expect a similar trend in IIP. Overall GDP, we are not that negative. We expect GDP momentum that we saw in FY25 to continue in FY26.
The outlook on GDP, Gaura, hi, this is Snehi also joining in. If you look at this number in solidarity, the IIP number that we've got, a 1.2% increase, we were estimating 2.3. Even the most conservative of estimates were estimating this number to be anywhere between 1.5 and 2.5, which means there seems to be a real reason for concern that the IIP numbers have gone down. Now, given the kind of backdrop we've seen on the manufacturing PMI front, while we are receding over there too, I will agree, but we are still above that 50 mark, which means that our activities are expanding. On one side, we have a little bit of hope of optimism over there. On the other side, IIP is largely trickling down. Can you help us understand this divergence?
I would put a little more weightage on IIP because IIP is actually incorporated into our GDP. IIP, in fact, is one of the main indicators for informal sector manufacturing in from the GVA side. The PMI index is a sentiment indicator. It is basically a survey where they ask companies month on month how are they seeing their order books in production. And if you notice that the PMI index have stayed above 50 even when GDP or profit growth of manufacturing firms actually slowed down from the second half of FY25, the PMI activity indicator never caught that dip. So I would say I would put more weightage on the predictive power of IIP rather than the PMI indicators. Their track record is not as good as the IIP. So what IIP is telling you is a story of external demand weakness, which is getting reflected in manufacturing sector. It's getting reflected in terms of electricity demand, though this is for the month of May. It's also showing you a picture of urban consumption weakness, which is also corroborated by the GDP. If you see Q4, we had very good GDP number above 7% print, but private consumption expenditure had actually moderated. So the IIP is also capturing that. For example, it shows you there is a decline in consumer durables as well as non-durables. So I would say the IIP is capturing what actually is the underlying growth story. The services side of the economy is doing much better, which is getting reflected by your GST payments. It's also getting reflected by the GDP, GVA services, which has remained above 7% consistently since even in FY 2025, we had a more than 7% growth in the services GVA. So IIP is capturing the manufacturing side weakness.
The ideal data to understand the shape of the economy? Is it GDP? Is it car sales? Is it IIP? I mean, if somebody has to look at a backward data to understand forward, what is the right benchmark?
For me, the right benchmark, I think, is company performance. So listed company profits, even if you see the GDP, it gives a very large weightage to list company results. For example, 75% of your manufacturing GVA is based on company performance, listed company profit growth. So I would say, for me, it's what companies are telling you, how company results are panning out, and you do see there is a sort of a softer growth in profit growth. If you look at even the sales growth for listed company performance from second half of FY25 or the entirety of FY25, at least for the manufacturing sector, the sales growth has been a bit weaker. So for me, the best leading indicator or indicator of current conditions would be what companies are actually telling you. For example, they have been consistently mentioning that the urban consumption side has been weaker, but we are seeing a pickup in rural thanks to the early monsoon, which you had earlier mentioned. We are seeing a pickup in FMCG sales good for rural. And also from the infrastructure side, the positive or the good news would be that the government expenditure, both center and state, in Q1 FY26 has picked up.
Right, Gaura, so that's the take on IIP data, and you've helped us understand a lot and put a lot into perspective when it comes to the demand on ground, when it comes to the rural areas, the urban areas as well. But other than this, Gaura, yesterday, other than IIP, we also had the current account deficit data that came out for us, our fiscal deficit, 0.8% of the FY26 GDP. What are you making of this number?
So it was expected that we would have a current account surplus in Q4, but the surplus was better than expected. And the surplus basically reflects that the trade deficit had dipped in Q4 with, I think, contraction on both the imports as well as a pickup on the exports side quarter-on-quarter basis. It also reflects that the invisible side has stayed stronger. We've had very, very strong services surplus, a consistent strong services surplus despite the fact that we've had such global volatility, as well as extremely strong remittances inflows, despite the fact that crude oil prices have been weak. So the surplus that we got in Q4 reflects the robustness of the services surplus, remittances inflows, and the fact that our trade deficit actually fell in the final quarter. So the overall current account deficit was a very moderate 0.6% of 0.6% of GDP for FY25, basically indicating that the external metrics of the economy remain pretty strong. We have very, very low current account deficit, extremely low external debt to GDP, which is a good sign in terms of external macro stability indicators.
Okay, Gaura, on that note, we'll let you go. Thank you so much for joining us and putting into perspective the numbers that we have seen on the IIP front as well as our surplus number that we saw yesterday. Thanks so much once again.